Ajay Srivastava joins us now. Let's take the market conversation forward. Ajay, when we spoke last, it was on the budget day. It was not once upon a time. It was on 1st of Feb. On that day, everyone had their chins down. Some were irritated. Some were generally concerned about the narrative which markets, the budget narrative. The general view, at least in Mumbai, when I spoke to some market veterans, was that markets will go lower and much lower than when they were. What are we staring at? We are staring at a lot of strength, good comeback, record highs, and comeback in the market breadth. So budget was okay. Why are markets looking great?
Well, I think, good morning. One thing is very clear that the RBI policy itself was very, very supportive. And I think that was a great surprise because there were a lot of nice and refreshing aspects to the policy compared to dogmas of the past. It may have its own risk, I'll acknowledge that, but at least it is a path forward to do something different. Number two is you alluded to the budget. I think, see, budget per se itself, let's be honest about it, has nothing great about it. Everybody is correct. You will see lots of cuts. Growth is not going to be happening. Nothing is happening. But since when has stock market and economy being so linked together? We are all being driven by global flows or at least local flows. The number three is that I think this whole thing about value in mid-cap, etc., has been built up to a crescendo at this point of time. So more than institutional money, it is a lot of local money which has gone in, buying the same old stocks. If you look at Bajaj Finance was 4,000, is 4,700 and so on. So I think it's one of the times when you feel that the local money has been convinced that this is the right time to buy into the market and they have bought the same old themes. I don't think mid-cap has been such a great theme, but by and large the same old stocks. So, you know, we are at a time where if absence of a bad news is good news and there is so much money on the sideline, the sheer liquidity, you saw the surplus liquidity of the banks, everybody's got so much of money, what do they do with it? So they go and buy a Nestle or a Bajaj Finance or Hindustan Liver or a PVR or an Apollo and say, okay, maybe not this year, maybe next year, maybe next to next year. So from market participant, we look at what's going to happen in this year in terms of economy. But investor is saying, I'm okay with a 5-year horizon with a Nestle or a Apollo Hospital or a PVR. I'm not looking at a 1 year. So it's a very different time frame which investors are looking at today compared to what the market participants typically believe in.
So Ajay, what is the bottom line here? The bottom line seems to be that more and more money is going to come because China is going to slow down. That will have impact on global growth, and central bankers will ensure that interest rates don't go higher in the short term. If the underlying thesis is intact, can I say the fabric of the market will remain the same? Because budget has done nothing which will take us back to 7%. And if flows are strong, those same 15, 20, 25, maybe 35 in your definition, those stocks will keep on marching higher?
You know, the scary part is, I tell you what worries us to the end, that if you even look at the phenomenal Delhi elections which has just happened, economy doesn't seem to be an issue with anybody at this point of time. You know, so one would tend to believe that there's an urgency in the government or the system to address an economic issues because those affect the electoral fortunes. Doesn't seem so. Neither the winning party, which had standing win, spoke about the economy, neither the ruling party, which had nothing much to comment about, spoke about the economy. So yes, you're right, we will trundle along as far as economy is concerned. The question is, one day the paper will call you when they say the dichotomy between economy and what's happening on the in terms of stock market will come to bear. Having said that, I would still say that in a struggling economy that we are going to see, you will see more and more concentration of economic power with the top 100 or 200 companies. So in a manner of speaking, the wish of the investors will come true that while the economy may struggle at 5 or 6%, some of these companies may produce good results. That's one. Number two is the lobby is strong. You know, let's not neglect the fact that you mentioned the budget and we were saying, if you look at every result of every company, it's the tax benefit which went into this year. That's not going to be the next year. The base effect will catch up in the next year. So it's going to be a troubled time for the economy, but investors have nowhere to go. You know, if you were a money in a bank, what do you do today? Now, you're not going to buy a mid cap or a very small cap given what's happened, decimation of a coffee day or an Eros Media has happened. You will buy the same stocks at this point of time. So I think we will trundle along. The worrisome part is the lack of electoral response to economy is not the good sign for us, because that means the urgency to handle economy is not there at this point of time.
Does one invest in this low liquidity, low growth, and abundant cash environment?
Sorry, come again?
No, so how does one go about invest, Ajay, in this environment of low growth and abundant liquidity environment? Because if you park money in fixed deposits, they're taxed, and the rate now has come down to 5%. If you don't park your money in fixed deposits, then the options are equities, maybe real estate, selectively commercial, or go back to equities.
Well, I think you need to, one good part has happened, that while this market is doing well at 12,000 and thereabouts, large pockets of these are at a historic lows. And one of the key standpoints is that the biggest destruction in value has been in the PSU stocks. If you look at the last 5-6 years, I think the sheer market cap reduction could have financed all our fiscal deficit by that point in time. But the other hand is that it gives a tremendous opportunity. If you're getting your oil marketing companies, your resource companies, your oil pipeline companies at closer to 1.25 book value, if you look at GAIL was 121, the day dividend of 6.5 rupees was announced. Now that's incredible situation out there. So I think there is a need to be in some of the pockets which are monopolies. Yes, there are PSUs to that extent in that market. More value destruction can happen, but at some point of time you can't destroy more value than what you've done. I think we are reaching a point where it's so down that can you do more? Maybe yes, but perhaps not. So I think there are pockets. You don't have to necessarily go to the larger pockets of a Nestle's of the world at 90 Ps. I think you can be in some of the pockets getting good dividends and hopefully good returns. So PSU block is one. Healthcare has flattered to deceive, with a great advantage that all healthcare companies now are deleveraging at a frenzy which we have not seen before. So in a matter of a year or so, all Indian pharma companies will have a leverage of 0.25 or below that number, at which point of time serious value starts to emerge. So you have a PSU sector and resources, you have a healthcare sector which is available for the asking. So and number three, of course, is that you have the metal companies, which are again absolutely at the bottom end of the cycle. So I think there are pockets to invest in. You don't have to be at all times. And the dilemma is not that where do you invest? Dilemma is how much more do you invest in the large cap? Now, whether it's Bajaj Finance or HDFC Bank or HDFC, question is, in a portfolio which is already 70% with that, how much more do you load? So what we've done is we're loading up with PSUs, we're loading up with healthcare companies to be a counter-cyclical that at least the alpha value will be significantly higher. It's not been proven true so far in the last 12 months. It's been on the negative side, in fact, but we are hoping it will turn around. So guess is at least find some stable pockets of returns rather than just piling up into the same shares.
Ajay, you're saying find some stable pockets of returns, but they do continue to be the same names. When we're looking out for multi-baggers, there's a sense that perhaps we might miss out if we don't get in at these levels. I mean, that's what retail investors could possibly be thinking, because despite all the recent blips we've had, markets have continued to bounce back, whether it be on liquidity, on the outlook going forward, on growth, continuing to be positive for the longer run. In that context, what about PSUs? Again, when it comes to some of those cyclical names, infrastructure. I mean, what about some of those pockets that still seem to be fairly beaten down but could provide manifold returns?
See, we discussed PSU stocks in context that represent very high risk and very high return, because I have not understood why anybody would have destroyed this kind. How can one destroy this kind of value in 5 years or 6 years period, which is phenomenal. So I'm not sure. I'm a buyer. I have a large holding in PSU stocks, to be honest, and it runs across the spectrum. I got oil marketing companies, I got gas companies. You name the PSU on a dartboard, and I think I'll have it in the portfolio. But it's a very tough call, but we have taken the call, and we are enjoying the dividend to that extent. But I think let's be honest about it. If you look, we can't blame the investors when they look forward for next 3-4 years. They need to find safety. We are in an economy which is 4-5% growth rate and sitting. If you just read the budget, It's a scary document. Look at the write-off sitting on it. The Food Corporation of India, the electricity distribution companies, and now the government says that will not be able to compensate the states for the GST. So growth is going to be really out of the window. Now, in a scenario of poor growth, now that's a difference between America and India. People, I think, look at America and say market is going up. America's moving economy is gangbusters. They are global conquerors. All right, so don't take the analogy that this will happen. And that is why only select companies are being picked up in India to say that if the analogy of America is true, that India needs to also, maybe a Bajaj Finance will rule the roost, or an HDFC, which is partly correct, because we look at the financial landscape, it looks scary that I don't think many will survive in the next 3 years' time frame. The RBI has kicked the can down the road, MSME restructure, all restructures, 1 year, 2 year, and so on, which is required perhaps. But what will happen in 2 years' time when all become bad debts? Let's be honest about it. So we are looking at the transmission company bad debt, production electricity bad debts, Mudra loan bad debts, now the MSME bad debts. So if you were to put your money in the bank, where would you go? You'll just go to an HDFC bank, maybe a Kotak bank, and put the money and sit tight. So I can't fault the investors, and we must respect that wish of the investors to say that in an economy which is as wobbly as ours, we are not willing to take risk with our money. We are willing to ride with a Nestle, willing to ride with an HDFC or a Bajaj Finance, but not willing to ride with a Yes Bank or an IDFC first. And I think it's a very sensible choice. Let's not say it's a wrong choice. I think the very sensible choice, and I would still say to the investors that all it does is takes your horizon of return longer and longer. And we thought, I'll be honest with you, we had a large holding in Nestle. We thought Nestle, we were just buying and it's going to take 5 years. It gave a fantastic return in 12 months' time. So the market can surprise you, but I still say this is a market for quality, not for risk. I think if you're buying value on risk basis, on mid cap and small cap, you're going to come to serious grief, as all of us have come in the last 3 years.
There was a view, Ajay, that the market's getting specifically focused, on earnings, on performance. So when we're talking about the mid caps and small caps, and we've seen that in this earnings season as well, there have been those select names that have shown steady performance. So, I mean, would you stay away as just a blank risk averse, or would you actually also look for some of those quality names in the broader markets?
Well, again, it's a definition of what is the mid cap. As per SEBI formula, the mid cap is fairly large because it doesn't leave much in terms of, it does on the market cap basis. Now, would you qualify SRF to be a mid cap or a large cap? I'm not sure. It's done absolutely fantastically well for in terms of performance. But so therefore, we are talking of companies over 2,000 crores, 2,500 crore turnovers. That's a different animal altogether. When we talk of mid cap, we talk of companies sub 500. And that's an extinct species. Let's be honest about it. Very few will survive, very few will remain in the 3 years time frame. So it doesn't matter, you may have an odd quarter, good or bad. The honest answer is, in a 5% economy, if the market leader grows at 10%, that means everybody else will have to degrow by almost 50% in terms of their growth rate. So arithmetic is clear. It's against the small companies. So an odd good result should not get you in. And let's be honest, we're talking of mid cap is anything below 750,000 crore, I would say is a mid and the small cap. Above 1,000 crore, you got to be specific about where you want to be. Lots of good names. But again, overvalued. If you look at the Path Labs, Dr. Lal PathLabs, Metropolis, hugely overvalued in context of the growth scenarios and what's going to happen there. So really speaking, growth is where the FIs are going to buy at the end of the bottom line. Growth is not going to come where the local HNIs are going to buy, because a single jerk and the price cut could be 20, 30, 40%. So let's be honest, in this environment of low economy, draw the line and say, unless you are willing, like us risk takers, to say, I want PSU, healthcare, etc., your dividing line is it on the FI list or not? If it is not, it should not be on your list also.
Tends to be learned from DMart.
To believe in an Indian entrepreneur who can run a retail story. Retail as a sector, we all thought it's gone and out, but I think that's an amazing story out there. Surprised everybody. And not only DMart, I think the second one which has surprised us more than even DMart is IRCTC. Something which you look at it, you give up, and then you walk it 3 times in a manner of 6 months or 9 months, and so on and so forth here. I think let's not lose heart. if you have missed out the story, because there'll always be such cases, you know, as DMart, etc. So the lesson is that you will find such cases. Enjoy the look of it, congratulate the guy who actually invested in it, but stick to your investment thesis, because while looking for DMart, you may end up buying a coffee day as well.
Tweet this later in the days, Ajay. Your thoughts before I tweet it out, that a great compounder can also be a multi-bagger. I mean, look at HDFC Bank. It's been a multi-bagger, but it's been a compounder, then it became a multi-bagger. Which is that great compounder you think, which looks like a compounder today, boring, dull, ordinary business. We all want 50% returns, but it'll give you a 15% return. But end of the decade, it may turn out to be a multi-bagger.
I think, you know, Anuj on your other channel and I had a 3 year back, we discussing a similar concept, saying not HDFC, what would be the next Maruti, and we had volunteered to add to our, you know, not that we recommend the stocks, to say PVR. I would still believe that that is one story which is going to be the story of the decade next year. Phenomenal, absolutely expertise, got the model right, passionate promoter. India is still just not even penetration is not even 10 to 15%, is going to be the story of the decade in our view, personally speaking, if you ask me. So if you look HDFC Bank, I think that could be the next big one, and you know, it's a good part because all of us go and see movies, so we keep contributing to their earnings.
I chat with a fellow fund manager of yours who said that PVR and Anox, they both could be a multi-bagger. So yeah, point well taken. So appreciate your time, Ajay. And thank you for joining us, and hope to see much more of you going forward.
Thank you very much.